This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Alright, this is the second chapter on interest rate risk management. And it's a much shorter chapter because all we're going to look at in this chapter are swaps. But I've kept it separate because it is completely different from what we were trying to do in the previous chapter. In the previous chapter, if you remember, we were borrowing at fixed interest. But because interest rates may change by the date the loan starts, we were looking at either fixing the interest rate using a forward rate agreement or using futures, or alternatively fixing a maximum interest rate by using interest rate guarantees or traded options. Here, it's a completely different situation. And you may remember, I said at the very beginning of the first lecture on the last chapter, I said that if you're borrowing money, you can either borrow at fixed interest or at floating. And fixed interest, if you borrow at 10% fixed, you'll pay 10% interest whatever happens in future to general interest rates. With floating rate interest, all right, it may start off being 10%, but the rate you'll be charged from day to day will go up and down depending on what happens to general interest rates. And everybody's got that choice, fixed rate borrowing at a floating rate. For everything we did in the previous one, we were always borrowing at fixed rate. But forget taking a loan in the future. If you're borrowing money today, some people prefer to borrow at fixed rate, because then the payment, the interest is guaranteed. There's no risk of it changing. But there are companies that prefer to borrow at floating. Maybe simply because the pretty certain interest rates will go down in the future. So floating will get the benefit. Or, more importantly, maybe because they think that their income is going to go up and down with interest rates. And if that were the case, higher interest, more income, lower interest, less income, it would make sense for their interest expense to go up and down as well. It would sort of match. As income falls, interest falls, and vice versa. Certainly an obvious case would be a bank. If a bank's borrowing money, their income is likely to go up and down, obviously, with interest rates. If they're borrowing money, why not have their expense, their interest they pay, go up and down with interest rates as well? However, there is that choice, and there are companies who want to borrow fixed, companies who want to borrow floating. And as you're going to see, if we do match together a company that wants to borrow fixed and another company wants to borrow floating, then potentially, not always, but potentially, both companies can save on the interest. And let me show you how that works, what we mean by a swap. Look at example 1. Company X can borrow fixed at 10% or floating at LIBOR plus 3%. So if they borrow fixed, they've been quoted 10. If they borrow floating, they're quoted LIBOR plus 3%. As I explained before, LIBOR is sort of the basic rate. The actual rate you pay depends on your credit rating. It'll be LIBOR plus, however much, depending on how creditworthy you are. There's another company we found who also has the choice, but if they borrow fixed, they'll be quoted 12%, perhaps the worst credit rating. Whereas if they borrow floating, they'll be quoted LIBOR plus 6.5. So in both cases, they're having to pay higher rates because they're less creditworthy. And it turns out X wants to borrow fixed rate Company Y wishes to borrow floating. So forget anything I'm about to say about swapping. If they do their own borrowing as two separate companies, as you normally would, X could borrow, once fixed, and they'd pay 10% interest. Company Y wants floating, and they'll pay LIBOR plus 6.5. And assuming they both want to borrow the same amount, we'd find a company that wanted to borrow the same amount as us, then the total they'd be paying between them, LIBOR plus 6.5 plus 10, would be 16.5%. However, what swap borrowing is, I'll show you the mechanics of it shortly. You'll have to be patient. But swap borrowing is effectively where you borrow the opposite of what you actually want and effectively pay each other's interest. Let me show you. X wants to borrow fixed, but suppose instead we have them borrow floating. They'll pay LIBOR plus 3%. Y wants to borrow floating, but let's have them borrow fixed, and they'll pay 12%. Now, this is only going to have to be sorted out shortly, but if they borrow the opposite of what they actually wanted, then in total, they'd only be paying LIBOR plus 15%. Now, that's not going to work. I mean, at the moment, X wants to end up paying fixed and Y wants to end up being floating. I said we'll come to the mechanics of this in a minute. But certainly by borrowing the opposite of what they want, the total they'll pay is that bit less. In total, between them, they're saving 16.5 minus 15, 1.5%. And let's find a way of making use of this and having them save money. Obviously, we want them both to save. Now, there's 1.5 to be saved overall. How much each of the two save of the 1.5, it's up to whatever agreement they come to. But unless you're told different, we'd assume they'd save equally. So 0.75% saving to X, 0.75% saving to Y. Now I've got to show you how we can actually achieve that. But there is this saving to be made. And although I've yet pleased to show you how we achieve it, if we can make that saving, then what will they end up paying? The end result. X, remember, wanted to borrow fixed, and if they did their own borrowing, would be paying 10. There is a saving to be made of 0.75%. And we've got to find a way of achieving it. But the end result, we're going to end up with X only paying 9.25. And similarly, Y wants floating. Their own borrowing would be at LIBOR plus 6.5. But there is a way of saving money. And the end result, they will borrow floating, but will end up paying LIBOR plus 5.75%. So there's what we can end up with. And in fact, in virtually every exam question, certainly recent ones, whether it have been swaps, that's been what you've been after. Again, it's not been a full 25 marks, this part of a question, but it's been after showing what the potential saving is, and as a result, how much they end up paying. Well, how can we achieve that end result? Now, there are various ways, in fact, it can be achieved. And I'm not too worried about for the exam, because in the exam it doesn't matter how you show how they achieve the end result. It really doesn't. I think the easiest, the most logical way of showing it is this. We'll have X and Y borrow the opposite of what they want, but then pay each other's interest. And so we'll actually have X borrow floating at LIBOR plus 3. X doesn't want floating and won't end up paying floating, but they come to an agreement with the bank to borrow at floating. Y borrows, they wanted floating, but have them borrow fixed at 12, but then pay each other's interest. So Y ends up paying 12 and X ends up paying LIBOR plus 3. Well, that's fine. We've now got X paying fixed and Y paying floating, but that's not going to be much of a benefit. If we stop there, X certainly hasn't saved anything. They're paying more than they would have done. Y is saving a huge amount. And we know what we want to end up with. We've just worked it out. We want to end up with X paying 9.25 and Y paying LIBOR plus 5.75. How can we end up with what we want? I say we can't leave it as X paying 12 and Y paying LIBOR plus 3. Well, the easiest way of settling up, make a transfer between them. You see, Y is paying X's borrowing and paying LIBOR plus 3. We want them to end up paying LIBOR plus 5.75. So we'll have them pay the difference, 2.75%, to X. And what will happen as a result? Y is paying LIBOR plus 3 interest. In addition, they're paying 2.75 to X. They end up paying a LIBOR plus 5.75. As far as X is concerned, they're paying 12 and receiving 2.75 from Y. And what's the end result? The end result is they pay a net 9.25. So they've both ended up paying less than they would have done if they hadn't have done this swap. They've both ended up saving 0.75%. Now, as I say, there are other ways they could settle up, which are much less obvious and aren't needed for the exam. It doesn't matter, because the examiner doesn't normally ask for the settling up at all. It's simply the end result. How swap can be used, how much we can save if we share it between them, how much they'll end up paying. We can save 1.5%. It's 0.75 each, and therefore, however we settle up, the end result will be X pays 9.25. Y, 0.75 less than otherwise, 5.75. See why it's happening, incidentally, because I started off by saying a potential saving. There won't always be a saving. But the reason is, you see, Y has got a worse credit rating. So in isolation, they're always quoted more than X. But if a fixed rate borrowing, they quoted 2% more. For floating rate, they quoted 3.5% more. And it's that differential, the 2 as against 3.5, that's giving rise to the saving. The saving, it's not a coincidence, the saving of 1.5% overall is the difference between the 2 and the 3.5. If the differential was the same, so if floating was also 2% higher, at 5.5, then there'd be no saving to be made by swapping. So that's why it's happening. that if there are these different differentials, then potentially there is a saving to be made. So that's it really. We'll do one more to make sure. It's there, so let's have a go. Example 2. Although, you know, it's another case of why not have a go yourself, pause the lecture, have a go yourself, and then come back and check you got it right. But this time, exactly the same idea. A can borrow fixed at 10 or floating at LIBOR plus 1. B can borrow fixed at 11 or floating at LIBOR plus 1.5. Companies A's income fluctuates with interest rates. So from what I said earlier, A wants floating. B's does not. But if B does not, presumably B wants fixed. And so, if there was no swapping, A would pay LIBOR plus 1, B would pay 11. Between them, they'd pay LIBOR plus 12. With a swap, we're effectively paying each other's interest. A would borrow fixed and so pay 10. B would borrow floating and pay LIBOR plus 1.5. And so between them they pay a total of 11.5. Now that's not how they want to borrow. Again, we'll swap who pays the interest sort of thing. But by borrowing the opposite of what they want and swapping, there's a saving to be made here. The difference of 0.5%. That's the total saving. And again, I mean, you could be told, oh, A gets 60% of the saving, B gets 30%, no problem. But unless you're told something like that, you assume it's equal. And so they're each going to save 0.25%. And so what will be the end result? The end result, A, they want floating. Now, if they'd done their own borrowing, they'd pay LIBOR plus 1. There's this saving to be made, 0.25%, so they'll end up, the end result must be LIBOR plus 0.75%. B wants fixed, and so without swapping it would be 11%. There's a saving to be made of 0.25%, 10.75. Now for probably the third time, usually that's all the exam wants, to know what the end result is, regardless of how it's achieved. For this one, I'll show you two ways of achieving it, because of something you might see in textbooks or answers which confuses. I've already said how they settle everything up between them is up to them. First of all, I'll do it the way I did in the last example, which I think is the most logical. A and B will have them borrow the opposite of what they want and pay each other's interest. So borrowing the opposite of what they want, A would therefore borrow fixed at 10, B would borrow floating LIBOR 1.5. We swap the two, and so A ends up paying LIBOR plus 1.5, B ends up paying 10. So A's ended up paying floating, B's ended up paying fixed, which is what they wanted. but they're not paying what they should be paying, you know. A's paying more than they should be paying, B's paying less. And so we know what the end result is that we want. It must end up with A paying LIBOR plus 0.75, B paying 10.75. And if we'd left it as it is, A's paying too much, B's paying less than they should. So the easiest way is that, again, they pay each other's borrowing and then settle up. Here, if B pays A, what is it? 0.75%. Then what will happen? B's paying 10% on A's borrowing, plus an extra 0.75% to A, and so in total they're paying what they should. What about A? They'll receive 0.75% from B, and therefore, what do they end up? They pay LIBOR plus 1.5, they get received from B 0.75, they end up paying what they should, a net LIBOR plus 7.75, and they both end up paying 0.25% less than they otherwise would. I said I would show you two ways. The other way I think is a lot messier and it's not really needed, but let me show you. A and B. With swap borrowing, they borrow the opposite of what they wanted. So A wants floating, A borrows fixed and pays 10%. B borrows floating, pays LIBOR plus 1.5. Well, instead of A paying 10% interest, but then B pays the 10%, and instead of B paying LIBOR plus 1.5, and then A pays it, the pure swap, as I had before, what we could have is this. Two things. First of all, A pays LIBOR to B. So A pays LIBOR, they're now paying LIBOR plus 10%. B receives LIBOR, they're now paying a net 1.5. Well, we can't leave it like that, obviously. LIBOR plus 10 and 1.5. Again, we know what the end result is. They must both end up saving 0.25%. So the end result, A must end up paying LIBOR plus 0.75, and B must end up paying 10.25. Was it 10.25? Yes. No, stupid me, 10.75. Sorry, in both cases saving 0.25. So the end result, I stressed before, that's what really matters. But how now can we achieve it? We need a second transfer that as things stand, B's paying LIBOR plus 1.5 and receiving LIBOR, so they're only paying 1.5%. They need, therefore, an extra 9.25. If they pay an extra 9.25, the missing figure, then the end result is what we want. They'll pay that to A will receive 9.25. So they'll pay out 10, they'll receive 9.25, so a net 0.75, and they'll pay out LIBOR. And so, although in real life that's slightly more common, instead of actually paying each other's interest, one pays LIBOR to the other and then the other settles up whatever's needed, but it doesn't matter. The end result is the same, and that is what does matter. Okay, that's interest rate swaps. I did mention, without doing any calculations, when we did foreign exchange risk, I mentioned currency swaps. Well, effectively, it's exactly the same. Not because it's fixed and floating, but because you might have the situation where you've got a UK company and a US company, and the interest rates they pay on borrowing depends on what currency they're borrowing in. So the UK company, if they borrowed in pounds, maybe they'll be charged 10%. But if the US company wants to borrow pounds, well, they haven't got any credit rating in the UK. They'll perhaps be charged more. Perhaps they're charged 13%. Nothing with fixed floating. Imagine these are fixed rates. On the other hand, if they wanted to borrow dollars, the UK person will be charged more because they're in the UK, they haven't got a US credit rating. They're perhaps quoted 14%. US, perhaps they're only quoted 9% because they're in the US. And maybe you've got the situation where the UK company wants to borrow dollars because they need dollars, perhaps because they're investing, they're opening a subsidiary in the US and it'll cost in dollars. And the US company wants pounds. And it's exactly the same idea. I'm not going to do a full numbers one on it. You see, if they do their own borrowing, UK would pay 10. Where are we? UK, sorry, would pay 14 because they want dollars. The US would pay 13 because they want pounds. So the two together, they'd be paying 27%. And so what would be sensible, if they both want to borrow the same amount, is for the UK to borrow pounds and the US to borrow dollars. The total would only be 19% between them. But then again, effectively pay each other's interest. So the American companies borrow dollars, but the UK company pays the interest, so they're paying dollar interest. And similarly, the American company wants pounds. Well, they actually borrow dollars, but they end up paying the UK's interest because they could borrow pounds cheaper. So there'd be this big saving to be made here, enormous, of 8%, which they could share. Exactly the same principles with interest rate risk, but they pay each other's interest. The only extra complication would mean converting money. Well, that would be up to whatever they'd agreed, and in the exam you'd be told they'd agreed to convert at this rate. And we've done enough before about how we go about converting.